All right, happy Friday, everyone. My name is Denver Noas with Wealth for Life. Today is Friday, and it's time for the recap of the Modern Family Dynasty Newsletter, which comes out every Friday. Today, we're going to talk about the number one asset for those that are in the top 1%. So it's be a good conversation, some good discussion. If you have comments, feel free to leave them in the live chat here on LinkedIn. And the replays of this will be available on the Wealth for Life LinkedIn group, and you should be able to find it on my profile as well. So as we kind of get into this strategy, if you're reading my newsletter every week, Modern Family Dynasty, you're getting close to 800 subscribers. On the LinkedIn version, I have a couple of thousand on the email version, but working to get the LinkedIn subscriptions up. So if you know anyone that would like this newsletter, do me a favor and give that a quick share. I would appreciate that very much, but I'm getting a lot of great feedback that people are really enjoying the newsletter. So thank you all very much for that as well. So let's get into the number one asset class for those in the top 1%. Unsurprisingly, it should be known that it's businesses. Businesses are typically one of the largest asset classes for those in the top 1%. But when you even look a little further, as this chart kind of shows, and you're looking at the ultra affluent, you're talking about close to 90% of them own at least one business. So ultra affluent is net worth over 25 million. 90% own one business. And when you're again looking across the board at the super affluent and everything else, like business ownership is one of the keys to scaling wealth. And it's again, my industry, the financial planning industry, financial advising doesn't talk enough about teaching people how to do businesses. So I'm going to go through some different types of businesses that you can own. One of them, of course, we'll talk about franchise benefits, because a lot of people, if they haven't started businesses before and they're new to it, it can be pretty, daunting with all the stuff and all the work that's involved. So franchise benefit, when you're buying franchises, there's literally hundreds and hundreds of non-food based franchises, like boring services, whether it be like, in driveway cleaning to garbage compactors to kids sports. There's so many, even in the longevity space. I mean, there's so many innovative franchises out there, and a lot of them have really low startup costs, and that's 60, 80, 100 grand range, but they can start producing incomes in the $100,000-$200,000 a year, and you start getting multiple units. And the nice thing about all of that is it's kind of that business in a box type method, where if you don't have a lot of experience, or maybe even don't have a lot of time, those can be a good bridge to do that. And I think that a lot of people sometimes in social media and stuff get turned off by the franchise fees. And there are fees for them for sure, but you're kind of having a lot of the work done for you. And those are also kind of easy to sell, as you can see, some of the things right here. Because when we look at what are our options to get into business, well, we have buying our own businesses, starting our own businesses, which is obviously great to do. But I certainly wouldn't recommend that without having other income streams. We'll talk about that in a second, because having been a business owner myself for 20 some years, raising a family with 2 kids, and you're the only one producing income from the business, there's certainly times where that can be pretty stressful. So it's good to set up financial systems to be able to have businesses, which we'll get into here. So, but when we look at that kind of those options, starting businesses, a lot of people are into buying businesses right now as well. But there's a lot of capital hunting for businesses. And you have to really get into the books, look at the systems, because again, I think what happens on social media is people start promoting how many baby boomers are retiring, how many businesses are going to be available, and all this huge opportunity, which I think there is opportunity there, but there's also a lot of capital chasing deals. And a lot of those businesses aren't always organized in the best way. So it really can take a lot more work to find the businesses to buy. So then with franchises, you're looking at speed to market. You can find an area, find a territory, find something you want to work in, and boom, you can deploy. And then, get multiples of going, have multiple locations, and makes it very easy to sell because you have everything's already systematized. So I think franchises are a good thing to look at if you're looking to start businesses. And then I also like, when you start looking at creator businesses in the digital economy. So that's things like selling, courses, selling consulting, selling digital products, using your expertise to kind of spread some of that value and share some of that wisdom that you've learned. You can see the numbers that really are pretty good for that digital economy. In fact, when you look at these, the amount of people full-time doing what they would call creator businesses, something over 25% are making 100 grand or more, which is pretty good compared to a lot of other industries. So there's definitely money to be made in those creator businesses. And I think that as a financial, even as a side gig, obviously that's something you can transition into and the returns can be pretty good. And I think there's really some untapped areas there. Like what this shows the age distribution. So you'll see that while most of those people in creator business are the 30s and 40s, there's actually a lot in the 41 to 50 and even 51 to 60. And I think that will be a trend going forward is older people into that market, because really I would say that that industry, if you think about marketing digital products and, whether it be courses and other things to baby boomers, services to baby boomers and digital products, that area is very much untapped because most of it is targeted toward younger groups. And so there is a lot of opportunity to provide service and value to the older part of the economy that are now coming on board and buying digital products and services. So there's a big opportunity there to do that. And obviously the advantage of those digital businesses is you don't have the overhead, you don't have the brick and mortar. Now you're going to spend more time and some stuff to get in there, but the overheads can be pretty low. Not to say that it's not highly competitive. So if you can find the right partners to work with, preferably jumping on with someone else's credibility and getting them to give you a boost, that's how a lot of people I know jump started their businesses. They got into using someone else or had someone else who had the influence already share their content, share their stuff, and that can really help a lot. So look, when you look at those businesses, and the reason why I bring up digital businesses a lot is because if you think about, you can go out and you build a digital business that has $60,000 a year in income coming in. You think about how much would you need in assets to produce that from traditional assets. So that would be roughly maybe a $1.2 million real estate portfolio. If you're renting out, you're getting long-term rentals. Or maybe if you're using stocks and you're following the 4% rule, even though that rule I think is outdated and not a good strategy to follow, but you probably need about 1.5 million in stocks to be kicking off this, 60,000 a year in revenue. So it's definitely worth the time, looking at these, how can I incorporate businesses in? And I think that's kind of the biggest question people, ask, because it is so easy when you look at most of the financial kind of news out there. It's very easy to be contrarian. There's a lot of negative stuff, and rightly so. There's a lot of reasons to be worried about things that are going on in the economy, but there's also incredible opportunities. And so the way that you capitalize on those opportunities is having the systems in place. And I talk about that a lot. If you've seen some of my other stuff about where most people are, they're in this advice where 99% of financial advice is stocks and bonds, and it doesn't feel safe for a lot of people. So you start segmenting assets out into different categories like offense, defense. And when you're doing that, then that starts to let you build the structure where you can start going out and having businesses, starting a business, buying a business, participating in other ventures like that, because you have systems in place that allow you to do it. And when you don't do that, people never get to that point because they're always kind of feeling uncertain about where they're at financially. They don't know if they're going to have enough for retirement. The market's going up and down. And it's really they don't have the systems in place. And then you get kind of victim to this contrarian marketing, and not that it's all hype or anything else. There are absolutely reasons to be worried about what's happening in the economy. But at the same time, there's always problems. There's always opportunities. And you capitalize on those opportunities by setting up the systems. And the systems are offense, defense. So an example of this is part of that concept of defense is I always kind of learn to kind of view assets in two different classes where there's appreciation only. So that's really what most people think of when you think of stocks, right? You must buy low, you must sell high, it must go up. There's no profits until you sell, and it's a paper asset. So that's the appreciation only model of where most people are with most of their retirement account, because that financial advice dominates the narrative. When you start looking at adding in harvesting assets, those have a system to take profits, taking gains off the table, earning interest. Those are the things you're going to think about, like hard assets, and of course, like businesses. Now, again, do we know you can lose money in businesses? Of course, you can lose money in businesses just like you can in stocks, but you're also making profits, locking them in, taking gains off the table. So that's a really integral part of defense, is getting to a position where you have more of these other types of assets, so you're not just dependent, on what the market does. Now, I know this particular chart is a little small right here, but this is kind of the return of alternative assets. And I wanted to bring this up a little bit because when you think about business ownership, a lot of times we have, you might have a job, you have a family, you have kids, you're, doing kids sports, you're doing, all the other activities. Life is busy. You don't have time to start a business. I face that right now. I already own a couple businesses, and I see so many opportunities of profitable businesses out there, but I don't have the time to do it. So another way you can kind of get intro to that right systems is looking at things like venture capital and venture capital funds, because that can be kind of a bridge where you start to get to know the process. You start to look at companies, when you're doing the right type of strategy with and a good team there, you're going to get a lot more insight into what's actually happening. And in the past, a lot of these strategies were farther away from, you as an individual investor having access. But as we know, that gap is closing. So there's actually more transparency and you can see more of what's going on. And in fact, I think that increased competition in those areas, even on the VC side, is trying to going away from that, hope and spray capital at something and trying to get a 1 out of 10 win, where you can actually get more targeted, having a basket of good companies at early stage that you're working with, and you have a good team that's doing the numbers, and there's more favorable terms for investors. So a lot of those things are changing, and that can be a bridge to that. But of course, just like owning your own business, you can lose. Just like owning stocks, you can lose. So what makes it possible to do these things is setting up the systems, offense, defense, to have this working. And someone in one of the comments on the post today from the newsletter had mentioned, how do you tell what's the right balance between offense and defense? Well, part of that is you go out there and you're kind of setting up, you look at your income targets, like what are you comfortably spending per month? What's your lifestyle? And then you start building to that number using capital efficient strategies that are tax efficient or tax free, strategies that are building defensive assets that harvest profits, using other people's money as shortcuts. So you start combining these things to building toward the target, having reserves. And when you have those systems in place, which, roughly 20, 30% of your capital, depending on when you're doing it, when you're starting, could go as high as 40%, depending on your age and everything else. But you shouldn't have to deploy as much capital as you think on these defensive strategies because you use capital efficiencies. Capital efficiencies I'm talking about is tax-free, you're reducing taxes. If you're eliminating a few $100,000 a year in taxes, obviously that gives you more capital to play with. If you're using other people's money to create tax-free strategies and defensive strategies, that gives you more money to play with. So when you start applying these other concepts, the systems, then that allows you to cover your future income needs with a smaller amount of capital. And now you're freed up to go swing for the fences and capitalize on opportunities. It's kind of like the old saying, never go to Vegas with scared money. And that's what keeps people from, getting into the right positions and missing out on opportunities, is because they're scared about losing, because they don't have their foundation set up. When you have your safe foundation set up, it makes all this other investing stuff easier because you're not going to get wiped out. Does that make sense? All right, and so I want to highlight that also as well. And then when you look at not just high net worth, we're talking about top 1%, but when you look at the investments of endowments and foundations, I manage assets for one of the largest foster care charities here in Arizona. It's great to work with endowments and foundations. But when you look at them, the vast majority of them as a whole, their assets are not majority of them allocated to the stock market, right? So on the left side of this chart, you have the mass affluent. 94% of their funds are typically stocks and bonds. Then you go to endowments, 43% are in stocks and bonds, of which probably half are in bonds. So they're really talking about 20% of their allocation of their growth strategies are in, the rest is in alternatives, like we saw in the previous thing, and that can be venture capital, private notes, secured debt, private equity, hedge funds, all these other strategies. So they're using a lot of other strategies. So there's lessons to be learned. And the gaps, like I said, the information gaps that used to exist to prevent people from getting into that space. Your normal investor typically still have to be accredited, but your normal kind of affluent investor now has more access to those strategies. And those are the things that can move the needle more, but you got to have defense set up first. So I will be going more in detail into those types of strategies. We have my next event coming up October 26th. This will be 5 secret strategies millionaires use to cut taxes, part 3, and 5x their wealth. So this one, of course, is going to be a little bit different than last time. Last time we covered reducing taxes by 50%, creating tax-free income, eliminating capital gains on exits, a lot of 3-to-1 tax-free matching. We covered a lot of that stuff, which you can watch in the group. This one, we're going to go into more of the 5xing wealth side and how do you structure these assets in the right way. The last events, we had, I think, 700 on the last events on part 2, 500 and something on part 1. So over 1,200 attendees for the last 2 events. And so make sure you register and check that out. We're going to cover a lot of good information. Now, in the newsletter every week, I cover the 4 sections. The first one is the learning section. Next section is the chart. And I'll go through that next, but also make sure that if you haven't already joined the Wealth for Life group on LinkedIn, wealthforlifegroup.com, you can just go there and that will forward you to the link. I put all these PDFs, replays, and resources and documents in the Wealth for Life group. There's a lot of stuff that I can't post just on LinkedIn because some of this stuff, quite frankly, is proprietary and you want to make sure that it's getting to the right people, but it's not getting exploited in the wrong way. So there is a lot of insider information that we do post in the group. And it's a good community of high net worth individuals and we're just kind of sharing strategies that can work to really scale wealth in a different way than you're hearing from mainstream media. So the chart of the week is, again, what's the income needed to be in the top 1%? It's a little hazy on the video here, but it'll show you based on each state what the income number is to get into that level. And just some of the quick takeaways, it's kind of more of like, hey, where am I at, in this kind of number to see what your percentage is. But when you look at incomes like 844,000 is top 1% in California compared to New Mexico is 411,000. And you look at that and you go, man, everyone in California in that high tax rate environment, you can go to New Mexico and basically give yourself a 50% pay raise. So it's interesting to see that. And then we'll see, you can see where the trends of people are moving to and how that affects things. So just some interesting information, see where you're at on the top 1%. And the next one was the productivity tip of the week. And that is, let's go to a 4-day work week. So there's more and more, numbers coming out saying, hey, 4-day work weeks can, they help reduce stress, reduce absenteeism, increase productivity. And this was a poll from Glassdoor where they surveyed 12,000 workers. 81% of workers say a 4-day week would make them more productive. And I think a lot of people would agree with that, but I'm curious to know from the community in the group, would you rather go to a 4-day work week? A lot of other, I think it's going to happen. I think there'll be some trends for that. So we'll see. And then finally, going into the concept of the week, that's kind of where I just kind of draw out some concepts for that. And this one is kind of this knowing the difference between the long and the short game, which is the income and wealth. Income is the short game, right? That's where you're working on cash flow. And you're trying to balance your time and energy between long-term wealth, which is the long game, asset appreciation, building all these long-term assets. So start thinking about that in the concept of businesses and the other assets that you own. Which ones are kind of income producing, which ones are going to be cash flow, which ones are short-term versus which ones are going to build long-term and be enduring and help to build that long-term asset appreciation. And what kind of strategies do both? I think you can certainly make the case that businesses can do both when they're structured in the right way. So that is our recap for this week. It is Friday. Hope everyone's going to go out and have a wonderful weekend. Make sure you join the Wealth for Life group, wealthforlifegroup.com. And my name is Denver Noas with Wealth for Life. Thanks for watching, and please reach out if you have any questions.